Okay, you've definitely heard of a FICO score, right? That little three-digit number that pretty much decides if you can get a loan, a credit card, even a mortgage. But what about FICO, the company? Today, we're going to pull back the curtain on a business that has a huge impact on our lives, but one that almost nobody really understands.
And that brings us to the big central puzzle of the day. You see, FICO stock trades for over $1,000 a share. I mean, that's a mind-boggling number. So how on earth does a company that operates almost entirely behind the scenes have a stock price that just towers over some of the most famous brands in the entire world?
Wow, I mean, just look at this. You've got a global icon like Nike, a brand everyone knows, and then you have FICO. The difference in their stock prices isn't just big, it's absolutely massive. This chart alone tells you that we are not looking at your typical company story. So what is really going on here?
All right, let's start digging in. We're going to treat this whole thing like a puzzle, you and me. We'll put the pieces together, one by one, until we see the full picture behind this incredible valuation.
Now, if you're thinking this is just another tech hype story or some kind of flashy new product, you can just throw that idea out the window. The real story here is honestly way more interesting. It's a story of quiet, methodical, and just absolute dominance over a critical corner of the financial world.
So let's officially meet the company at the heart of our mystery, Fair Isaac Corporation. But you probably know them simply as FICO.
This is the part you already know, the FICO score. It's basically the standard that lenders all across the U.S. use to figure out, hey, how risky is it to lend this person money? It affects everything from getting a car to buying your first house. It is a number with some serious, serious power.
But FICO is so much more than just that one number. The company really makes its money in two ways. First, there's the scores business. Every single time a lender pulls your score, FICO gets paid. And second, they have a software business, where they sell the complex analytical tools that banks use to make big financial decisions. It's a pretty simple but totally brilliant.
So, how did one single company become so essential? Well, it definitely wasn't an overnight success. Let's take a look at how FICO built its fortress, what you could really call a quiet monopoly.
You really have to see this timeline to get it. It all started back in 1956, when an engineer and a mathematician had this wild idea. What if we used data to make lending fair and objective? For decades, they just built their system. By the 80s, the big banks were on board. But the real game changer? That came in the 90s, when government-backed mortgage agencies basically made the FICO score mandatory. From that point on, it was game over. They became the undisputed standard.
And that right there creates this incredibly powerful self-reinforcing feedback loop. I mean, think about it. Lenders use FICO because everybody else uses FICO. And because the lenders use it, we as consumers have to care about our FICO score. This creates this massive wall that no competitor can climb over. The entire financial system is basically built on the FICO standard. It's a perfect, unbreakable circle.
Okay, so now we get to the motive. We've seen how FICO built its dominance. Now let's see how that dominance translates into an unbelievably efficient and profitable business.
This one sentence really gets to the core of FICO's financial power. High margin just means that most of the money it makes is pure profit. And asset light? That means they don't have expensive factories or giant warehouses. FICO sells information. And let me tell you, that is an incredibly lucrative business to be in.
And here's how all those pieces just click together to create this amazing profit machine. The revenue just keeps coming in. Lenders are always pulling scores. The cost to generate one more score for a customer is practically zero. And because they're the standard, they have huge pricing power. All of that combines to create ridiculously high profit margins. It's just a beautifully simple and powerful model.
So let's bring it all home. We've looked at the history, the business model, the monopoly. Now it is time to connect all these dots and finally solve our big stock price puzzle.
This is the question we started with, isn't it? We know FICO is a fantastic business, but that alone doesn't explain a stock price of over $1,000. The answer actually lies in two very specific financial moves the company makes.
Okay, the first piece of the puzzle is just simple scarcity. FICO has way fewer shares out there for the public to buy than most big companies. Think of it like a pizza. If you have this incredibly delicious, perfect pizza, but you only cut it into 4 huge slices, each one of those slices is going to be worth a lot, right? It's the exact same idea. Fewer shares with each one representing a bigger piece of a very profitable company.
Now this second factor, it supercharges the first one, and this is where it gets really interesting. FICO takes its huge profits and constantly uses them to buy back its own stock from the market. Let's go back to our pizza. This is like the pizza shop using its profits to constantly buy back whole slices, making the few slices left even rarer, and because of that, even more valuable. It's also a huge sign of confidence from the company. They're basically saying the best investment they can possibly make is in themselves.
And here's the crucial point to understand. FICO is a totally different kind of animal compared to the companies we usually talk about, like Apple or Amazon. It doesn't sell you a phone. It doesn't deliver a package. It sells essential, invisible infrastructure. It has high value precisely because of its low visibility and its absolutely indispensable role in the system.
So, what are the big takeaways from all this? First, a super high stock price doesn't automatically mean a stock is overvalued. It can be a sign of incredible quality and scarcity. Second, the best businesses are not always the most famous ones. And finally, companies that manage to weave themselves into the essential fabric of an industry, well, they can dominate and create unbelievable value for decades.
And that really is the ultimate lesson of FICO. That number you see on the stock ticker, that's just the end of the story. The real story, the one about quiet dominance, powerful feedback loops, and a brilliant business model, that's where the true value is. The mystery of the $1,000 stock, it turns out, isn't about hype at all. It's about quality.